Good morning. Welcome to IA Global Asset Management's quarterly podcast, where our portfolio managers and asset class experts discuss current market events, trends, portfolio allocation, and outlook. I am Rose Marcello. I'm a client portfolio manager at IUGAM, and my guest today is Alexandre Morin, who is Senior Director, Portfolio Manager, Fixed Income. Alex manages about 20 mandates within fixed income, among which IA's flagship for Canadian fixed income. Today, with him, we discuss the interest rate cycle, bond valuations within a historical perspective, and the risks to his investment framework. Good morning, Alex.
Good morning, Rose.
Thank you for being here. So, I'd like to take you back to late last spring. So, this year, you thought we had reached the peak of rates for this cycle.
Mhm.
But right now, we're almost 50 bips higher. What has changed in the market backdrop that explains this surge?
That is a very good question, Rose. I would answer your question that way. I think one of the obvious reasons I would say is that the economy, admittedly, is much more resilient than expected in the face of the spectacular rate hikes that we have witnessed around the world. Just to give you two prime examples very close to us, if we look at the Federal Reserve down in the United States, they reach a low point in the overnight rate at of a 1/4 of a percentage point. Right now, we are 525 basis points above that level. And here in Canada, also a very aggressive hiking cycle. The overnight rate was increased by 475 basis points. And everyone would probably remember in July 2022, the spectacular 100 basis points of hike that was done by the Bank of Canada. So very aggressive hiking cycle around the world, but still the economy is more resilient. Couple examples, unemployment, which remains historically low, grinding up a little bit, but still historically low here in Canada and even in the US as well. We should not forget also the price of oil that went up quite sharply since the end of the spring. End of June, a barrel of oil was worth about 70 US dollars. Now at 90 US dollars, we're talking close to a 30% increase. So this is a bit of inflationary when we have such a big increase. And speaking of inflation, although it is falling, it remains very high. The easy part of lowering the inflation is probably behind us. You know, it's easier for central bank to bring the inflation back to 4% when you start at 6, then going back to 2% when you start at 4. So the easy part of lowering the inflation rate is behind us. So those are mostly the prime reason why bond yields are higher compared to what we were expecting at the end of last spring.
I get it. But however, despite that, you still haven't changed your position. You
Mhm,
think that current bond yields are the opportunity of a decade, if we can put it like that, and you
mhm.
continue to invest in bonds. So, what are your prospects for the next 6 to 12 months?
Yes. Why do we maintain that positioning in our bond portfolios is, as a team, we believe that the risk here are becoming more and more asymmetrical in terms of the direction of bond yields because we think that the risks are being more asymmetrical in terms of the direction of the economy. So from now on, we saw many analysts and strategists, getting rid of their recession call as it relates to Canada and the U.S. economy. Obviously, when everyone is on the same side of the boat, let's put it this way, it's becoming pretty dangerous. It seems that everyone in the market is saying right now we won't see any recession either here in Canada or the US.
So
With
it's a crowded
on
trade.
our, yeah, it's a crowded trade, exactly. On our side, Rose, we are not convinced that the economy can emerge unscathed from the recent central bank hiking. Just look back in time. If we look at the Federal Reserve historical record, let's put it this way, as it relates to slowing down inflation and slowing down the economy, it never happened after such a brisk rate hiking cycle that the economy didn't fall in recession. There's only one exception to that. It was in the middle of the 90s with at that time the internet revolution. Some say that artificial intelligence may save the date this time around, but obviously it will be with time that we're going to be able to see if saying that was wrong or was right. When we look at some underlying data, we see some underlying data that are beginning to weaken. As an example, we hear more and more families that are having problems to pay their credit card, so the delinquency rate is going up. So this is some early signs that what central banks have done is starting to bite in the economy. From now on, though, what do we expect for the market? We think that corporate credit spread should underperform in a slowing economy, especially the high yield market and the less solid companies. And also, as an example, that we think that the bond yields are the opportunity of a decade. Just compare the yield to maturity of the Government of Canada 5-year versus the S&P TSX dividend yield. Government of Canada 5-year is trading at around 4.25%, as the S&P TSX dividend yield is about 100 basis points below that. So we definitely think that the bond market is worth being invested in this time around.
Okay, so you're still positive, and that explains your long duration bias. For your two main strategies, so one with a more Canadian focus and the other one which has a more global mandate, how has performance been so far this year? And maybe a comment on how those portfolios are positioned to benefit from your framework.
Sure. So if we look first at our funds with a Canadian focus, year to date, the total return is higher than its benchmark, despite a decline since the start of the third quarter with the recent sharp increase in bond yield. A couple of reasons for that. Obviously, I've been mentioning longer duration than the benchmark. So we are still comfortable with that longer duration because of our view on the economy, and we think bond yields will go down, especially next year. One important trade that we did this summer is that we reduced our positioning in corporate bonds. We think that spreads will widen in an economic slowdown. Corporate spreads are still pretty tight, historically speaking. So we took some opportunities to take some of the chips off the table and put our money in a more conservative manner. And obviously, as always, we maintain a lot of agility in our positioning. We like to use derivatives between US and Canada bond yields, some FX positioning as well. So long duration and basically a more conservative portfolio. Quickly, if I look back at our other strategy with a global focus, it's a little bit of the same. We have a better total return than the benchmark year to date, despite that Q3 decline. Basically, for the same reason, we maintain a longer duration than the benchmark. But in this portfolio, we have, let's say, our credit exposure is at the bottom of the curve. With an inverted yield curve, it provides an additional carry, which has been, let's say, pretty good for the strategy's performance year to date. Also, since we think the Canadian economy will fare worse than the US economy down the road, we maintain our duration bias here in Canada instead of the US. And the last thing I could say is that we have reduced our positioning in riskier assets, such as high yield and emerging market in those portfolios.
Okay, so overall, a more conservative and prudent positioning, given your expectations.
Exactly.
Considering all this, what are the major risks to your current investment framework?
Basically, with a longer duration and a more conservative portfolios, is the major risk is that our economy and the US economy and the economies around the world are continue to grow despite the brake that has been applied by the central banks. This is one of the reasons, and obviously, let's say another reason related to that would be that the inflation does not return to target, which forces the hands of the central banks to do more. So in that case, it would be tough on the value of the bonds. But on the opposite, since we have reduced our corporate credit exposure, it would, have some. It would reduce the impact on our portfolio. But clearly, the economy and inflation not slowing down is the biggest risk to our portfolio right now.
Well, thanks, Alex. Those are very good insights, especially as we come to the end of the third quarter and we're in the last stretch of the year. It's good to know how you're positioned.
All right. Thank you very much.
Thank you so much, Alex, for being there. Have a good day.
Thank you. Bye bye.